Hi, everyone. Welcome to Analyze Your Trade, episode number 32 for April 24th, 2018. Tonight, we will be discussing your trade ideas. So over the last few days, about 40 people started up to 5 symbols each, and I have put the list together of the top stocks, and you should see those on your screen right now while I'm talking. My name is David Cosmeter. I'm the creator of Timing Research, and I developed this show with Dean Jenkins of Follow Me Trades. And he's here today to moderate, so I'm going to go ahead and turn it over to him.
All right. Hey, thanks, David. And it's good to be back here. Thanks, traders, for tuning in, taking some time out of your day to hear what we have to say. So our other guy, Neil, didn't show up, so you might just have the John and Dean show. And this could get really interesting. And it's almost like Siskel and Ebert, because I'm primarily a technical trader, and I know John looks at fundamentals as well. But I'll
be showered with wisdom.
That's right. And we'll probably agree on some stuff and not on others. We'll get some different perspectives. But John, go ahead and introduce yourself, and then I'll say a few words about what I'm doing.
Well, that means this show has a combined age of 110 years. That's got to be good.
That's right.
I'm John Thomas, the Mad Hedge Fund Trader. You can find me at www.madhedgefundtrader.com. I am a global long-short macro fundamentalist. I use technicals for executing my trade alerts, of which there have been many this year. Our trailing daily audited one-year performance is now 55%. We're up 20% so far in 2018. And we cover stocks, bonds, commodities, precious metals, energy, and real estate. But most of the trading this year has been in stocks, where all the action is.
Okay, and it is good to be here with you again, John. We've been on several times, and I always enjoy it. And for folks tuning in, listening, if you don't get John's newsletter, you should, because whether you agree with him or not, he's an interesting guy and a great writer. So, and he gives good perspective. So I encourage you to sign up for his newsletter if you don't have that. And he gave the website there. I'm Dean Jenkins, founder of FollowMeTrades.com, and I am a technical trader. And I love it because I look at companies like CAT today, who had phenomenal earnings results.
Yeah,
and
right.
Got punished for it.
Yeah. Other than that, Mrs. Lincoln, how was the play?
You know, so I trade purely off of price action with some particular patterns that I'm looking at. I actually went to business school and learned how to analyze companies and was a fundamental trader for a long time. And I shifted gears, and I've been much more successful with that. I trade an average hold time of 4 to 6 weeks. So I think long-term fundamentals, for a buy and hold quality company, all that stuff makes total sense. But I'm a technical trader with a shorter hold time, and the technical patterns have served me well, getting an average annual return of about 35%. Again, my results are audited by a third-party CPA firm and published on my website. But that's it. I'm a technical trader. I offer a stock advisory alert service. I have a live trading room, hour and a half each morning during the week, and I offer some courses and mentoring. And I love analyzing charts, looking for trades. So we're going to be doing a little bit of that today. We're going to jump right in and take a look at the list that David has put together from you, the viewers, of what stocks you're interested in. The first one up here is General Electric, and I can't wait to talk about General Electric. But I'm going to let John go first on each of these, and then I'll weigh in with my opinion as well. So, John, tell us about.
You don't overcome a decade of mismanagement in a week, which essentially is what the stock market is trying to tell us. So I think this is just another dead cat bounce, another short covering rally and a long-term trend. At the very, very least, we have to go back and double bottom at $12 to see if this is a real bottom or just a pause to a new low. The fundamental story is terrible. It's going to take years to unwind all their headaches. They made some of the worst time bets ever in energy stocks, financial stocks, and healthcare, which have wiped out the good portions of the company, which are jet engines and other things. So I'm going to pass on this. Too many other better things to buy down here. I'd rather buy Amazon on a 10% correction than waste any of my capital with General Electric. And that is my view.
And that is crystal clear. You made your point. For general, again, I'm a technical trader, so we're going to have different perspectives, and I'm also probably trading a different time frame than John. So, we could both disagree vehemently and both be right about a trade because different approaches, different time frames, and stuff like that. So on GE, I do agree. We are in agreement that I would not try to go long right now. I use Dow theory to look for a change in trend. And if you look here at GE, many times in this downtrend, it is headed up, right here, 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 and here. Never has it had a pattern where, according to Dow theory, you get a trend change. A downtrend is lower lows, lower highs, lower lows, lower highs, lower lows. So far, this is a lower high. If we get this move up and a pullback and it stays above that support level and then a new high, that's a different pattern that we haven't seen in a couple years, and that would be breaking the Ichimoku cloud, and then we could have a real move up coming. And it doesn't have to be that anything fundamentally has changed with the company. It could be a short covering rally. It could be simply some optimism, and who knows. But if that correction up begins, the Fibonacci retracement zone is up here from $20 to $24, and if we get that kind of proof, I'll take it from about 15 bucks up to 20 to 25. I would be happy to take that long if we get this pattern, and we're not close to that yet. We're probably a few weeks away if it's going to happen. So I would be interested.
I think that the burden of proof on this one's on the bulls.
Yeah, so it's got to be proven. It's not there yet. I would be interested because it's there's plenty of profit potential there, but again, not qualified yet. But I am watching it. It'd be fun.
By the way, one other thing on GE, if you still have it, first of all, you've been asleep for the last year and probably shouldn't be trading with real money. But second, I would keep it. If you've taken a hit from 32 to 12, the damage is done. The likelihood over the long term is that you'll make your money back, but it could be a very long time.
Yeah, I would agree with that, unless it goes below this support level at 12. If it goes below that, take the hit, man.
Well, the breakup value is 15, so I don't think we go a lot lower than here. It's just a question of how long until the next bull market resumes, and my guess is it's the next economic cycle, the one after the next recession, which probably begins next year. This could be a great 2020 play, in other words.
Right. And meanwhile, you could have had that capital doing all kinds of cool stuff.
Yeah, you could have done 100 different trades in the meantime.
Yeah. All right. Twitter. Funny, I've traded Twitter. I would not be opposed to trading Twitter. I actually hate the application. I just hate it. I don't like it. Whenever I get Twitter alerts, it's the most frustrating thing to go try and find this stupid message. And I'm reasonably technically savvy. But in terms of a trade, what do you think? What are your thoughts on Twitter, John?
Well, the miracle here is that it got back to where Microsoft bid for it 5 years ago. It's back to the $31 takeover price, which they turned down, before the stock went to 15. I've never been a buyer of the Twitter story. I think, with the president giving them free PR every day of the year, multiple times a day, the stock would be a lot higher. Advertising type models are under suspicion now, as you're seeing with the problems at Facebook. So I'm not looking for new ways to add to my advertising exposure. I already have Google and Amazon, so I'll give this one a pass. Too many better fish to fry. Better off buying something like a Square, a PayPal, a Box, something like that.
All right.
Thumbs down on Twitter. And as you can tell, I'm not a 140 character type of guy, and I'm not even a 280 character type of guy.
Yeah, like I said, I hate the platform. I just do. And I don't like the chart right now either. It's a pretty volatile chart. It doesn't have the kind of clear, orderly price movement where you can begin to predict and project something. I've got some projections on here, but I don't have high confidence in them. I think there's way better trades out there. I think it may have already done its thing. So I'm not interested in Twitter either.
And by the way, I live 2 miles from the corporate headquarters as the bird flies. And every day I'm running into Twitter people at lunch or on hiking trails, and they're all depressed and waiting for a takeover bid from somebody.
Interesting. All right, applied materials. It's our next thing here. What do you think, John, on AMAT?
Well, you really have to make a call on the entire chip sector. They're basically all trading in unison now, whether it's advanced micro devices, NVIDIA, Lam Research, and we think the chip sector has more to run. I don't think it's peaking here. It's transitioning, in fact, from a cyclical to a secular trend upward. The demand for chips globally is just so enormous. So I would be a buyer on this dip. And we're actually very close to a $45 bottom here. That would be a real sweet spot if you can get in there at $45, $46, because then you could look for another run back up to $62, $58 at the least. So lots of volatility here, very, very wide range. I mean, that's a 40% wide range from the recent top to the recent bottom. That's a lot to trade around. So I would be a buyer of the dip. We think this thing closes the year at a new high. So bullish on AMAT.
All righty. And it's interesting, like I said up front, John and I could disagree and both be right because we are probably trading in completely different time frames. So I see a bearish pattern, but I see the top of the retracement zone. Here is these Fibonacci retracement lines. And the top of that zone, which is where I use for my risk to reward calculation, is right where John's saying the bottom probably is going to be, right around 45. Yeah. So I see a short setup, but to take this trade, my stop would be here. And if I enter here, you can see it's got a terrible reward to risk. My reward is, from current price at 48 down to 45. It's a $3 reward, and the risk is from 48 up to high 50s. So I have a chance of losing more on this trade than I make, and I don't take trades like that. So no trade there for me. It's a short answer.
Yeah, the worst case, you go down to this 45 level, and then you try and create a head and shoulders top, which takes you at least back up to, say, 55. That's still $10. It's still a 20% trade. Then you can decide if you want to keep the trade, play for a breakout, play for a narrowing triangle, and then a breakout into year end, which is most likely going to happen. You come in, like they say in the trading business, you make your profit on the buy. And the buy on this one's at 45.
Very interesting. All right. So the next one, as you mentioned, and you mentioned it in your list of chip-related stocks, is Lam. Let's see how their chart looks. LRCX. And the chart, if you took the titles off, looks exactly the same.
Yeah, the whole chip sector looks the same. This is an industry where overall demand for their products is going to rise 10 times in the next 5 years, and it's currently growing at about a 50% annual rate right now. So the fundamental story is there. We flirted with the 200-day moving average today. I actually, we've been in this stock for several years. People made fortunes. We actually were telling people to start taking profits at the last peak because nothing to do with Lam Research, the whole tech sector and the whole market is starting to roll over and discount the next recession, at the very least, the next election in November. So for a trade, there's a nice one setting up. Well, the perfect entry point would be 160. And given that we're getting these down 700 point days in the Dow, you may get 160. And I would wait for the market to come to you. This is not a market where you chase trades. You wait for the trade to come to you at your price, or you walk away from it. You're spoiled for choices out there. So yeah, 160 is my number on Lam Research, and you can probably get a 50% move if you get in at that price.
That's pretty interesting. I got that same level projected here, about 160, and that's that prior low,
right
at the top of the Fibonacci retracement zone.
Well, it's also resistance on the earlier two moves up, so a lot of congestion at that level. There's probably a lot of people trying to add to this stock at around that price level. You know, big institutions, that sort of thing.
The difference between this one and Applied Materials, we got about a 1-to-1 reward to risk. If we took the short here down to 160, you'd get about a 1-to-1 risk. That gets better. The other one was, you know, upside down. But this still is. I like 2 or 3-to-1 reward to risk ratio trades, and you can find them. They're out there, so there's no need to take a marginal trade. And I totally agree with your comment. It's what I teach about not chasing or forcing trades. I think one of the biggest mistakes people make is, you know, fixating on a stock or a small handful of stocks and going, and the question seems to be, you know, pick one, Apple or Lam, go, how am I going to trade Apple? And for me, the question is, should I trade Apple? And if the answer is no, let's go find something better, because there's thousands of them out there. It's a target-rich environment. So go find good trades rather than anguishing over how am I going to trade something that may not be in the best position. Like you said, John, don't chase it, but let it come to you. Go find good trades, or let the price that you're waiting for happen, and don't force a marginal trade. I think that's good teaching. RH, I don't even know what RH is.
It's Restoration Hardware, and it's amazing this thing hasn't gone down more than it has, being in the retail space, which is just disappearing up its own exhaust pipe. It's roadkill for online sales of all kind. Even if I liked Restoration Hardware, I would only buy stuff off of their website, which doesn't say too much for Restoration Hardware. So don't want to touch it. Fundamental story is horrible. When the market recovers, the first thing they're not going to do is run out and buy a bunch of retailers. They're going to run out and buy Amazon, Google, Facebook, and Netflix. Like many other retailers, there's a huge brick and mortars branch network potential Chapter 11 here down the road. So not the first choice to put into my retirement fund. Thank you.
Yeah, I don't like it either. I don't like all these gaps and just kind of random volatile moves that don't have any kind of order or reason or pattern to them. And I avoid stocks like this just purely on that technical basis. So interesting that it made the list. It must have been in the news and on people's radars, but yeah, I don't like it. It's a gappy, volatile mess. ANET.
Yeah, that's Arista Networks. It's one of the smaller networking companies. Had a 400% return with the rest of the technology sector in 2017 back to 2016. Has been dead money so far this year, and looks like it wants to test lower before it finds a final bottom. So I think the market's first choice here is big tech. I'm going to try to avoid small tech, and this is one of them.
All right, I see we are in a downtrend, clear evidence of it, It has lower lows, lower highs, lower lows, lower highs. It's broken through each one cloud. We got negative momentum. We are coming down the 200 moving average on a lot of these provides a pretty significant level. It can be a significant support level, and if it breaks through it, that's big news too. But at this point, it looks like it's projecting support at 200, which coincides with the top of the Fibonacci retracement zone. So that's probably where we're going, is about 220 in this current down move. And again, not a ton of juice there. You know, from 252, it's 30 bucks, but on a percent basis, it's not that big. And you know, compared to where my stop would have to be at the last high, it's again about a 1-to-1 reward to risk ratio trade. Not super. There's better ones out there. Probably pretty probable of getting down to this 220 level in the next month or two. But I think there's higher potential trades out there still, and I'm tracking a couple better than this for shorts. LPTX. Leap Therapeutics looks like it is a fairly recent issue. The data doesn't go back that far. But Leap's all over the place. You got a read on Leap, John?
Yeah, we've been avoiding the entire biotech sector. I just picked up a bad echo here. Are you hearing it? Okay, it's gone. Yeah, like I said, we've been avoiding biotech all year. We think it's a political sector. It's the wrong political sector. They can get hit by a tweet at any time. And this is a small oncology stock, a niche oncology stock. You know, probably good for the long term, but we're very close to the IPO price right here. So it's basically gone nowhere in 5 months. And it's really more of a small cap play than anything else. And you know, if you're into that sort of thing, you know, down 35% from the peak last week is not a bad place to look at it. But clearly something horrible happened here on the earnings front, and we don't want to touch it.
Yeah, I'm not interested in this. This doesn't have the technical setup, and it is a volatile stock. Look at the intraday wicks on this thing.
Well, that's typical for the whole sector, though. All these small biotech stocks trade exactly the same way. I learned the hard way that you avoid these things, except in all but the most ideal situations.
I don't know that they all do. I'm showing one. This is a trade we took. This is a Tandem Diabetes Care. This is a trade we're just wrapping up. But we're up 50%. You see, this one's far more orderly. We took our entry at 503 on Tandem. We took our profit up around $7. That's not a bad, you know, nearly 50% on a trade in a couple weeks. So,
well, you also have a much longer price history there, so you have more to work with as a technical analysis. The trouble with these recent IPOs, there really is no history. The market's kind of groping around in the dark, trying to figure out what this thing is really worth. So, you better stand away if you're taking this from a technical point of view.
Yeah, and I made that point as well. It's too recent, and its intraday moves are very volatile, very volatile. Obviously, a lot of news and hype around this thing, probably. Sirius. I'll never have another vehicle without satellite radio. I'll tell you that.
I know you can get CNBC on it 24 hours a day.
So I as a customer, I really like Sirius XM. As a trader, I don't know, not so sure here. What's your read on Sirius?
Well, you know, I love the product. Also, I keep mine tuned to the comedy channel most of the time. Start my day out with a few laughs. But it's almost a one-off as a sector. You know, there's not a lot of satellite, you know, radio companies out there. It's also an advertising play, which puts them at risk of cannibalization from Facebook and Google. And it's a very small company, so we've never had anything to do with it. I don't really see anything inspiring here to look at. So I'll pass on this. don't have a view one way or the other.
I think they again, I like their product. I'll never own a car without satellite radio again. And I think they made a brilliant move in that, you know, every rental car in the United States has satellite radio enabled, so people get to try it out. And I think all new cars have come enabled. All you got to do is now call and have it turned on, which is really, really smart. No hardware outlay to get their service. But in terms of a technical play, they're just about done. They, you know, here I use Elliott Wave, a very simple approach at Elliott Wave for my analysis. They already had the initial impulsive wave. They had a correction. They had to follow through up to the target zone. Typically, the next move is an ABC correction down. It's pretty volatile, hard to trade. So there's no setup there for me on Sirius. But I'll keep giving them my $100 a year for forever. They got me as a customer, but not as a trader. So we're about halfway through the list. Why don't we step back from the list for a minute and share a trade we do like right now? What a good trade setup that we would share with the listeners there, John. What do you
I don't like anything right now. We just went, you know, 90% cash in one of our funds, and the other one is 10% long and 20% short. You know, what do I really like? You know, short S&P 500s and long the VIX, which is how we've been for the last 2 weeks. And, you know, we already started taking profits on our, you know, short SPY position. VIX we're hanging on to because the way VIX trades these days, it really hangs up there right until the very end, until it collapses again. So keeping the long VXX call spread as a hedge against our long, and it's working really well. Next time VXX gets back to 40, you want to buy it for another one of these 700-point meltdowns, and VIX goes up 10%, 20% in a day.
There you go. Long the VIX, short the SPY. Yeah. I like the SPY short right now too. We went
into that trade a week ago last Friday, and it's been a big payoff for us being on the short side this month. So kind of late to do it now, but I would use this on any kind of rally. I don't see we get a major up move in the market for another 2 months when we run into the next quarter's earnings reports. Until then, it's either down or chop sideways.
I agree with that. And maybe by the end, I'll have a chance. I'll show my analysis on the SPY chart. Yeah, I think we're. Oh, I got muted just in time when I was sneezing. Yeah, I agree. Down or sideways, and probably biased toward the downside. But a trade I do like short right now, and there's room to get in, is Citigroup. We're short Citigroup. We got short at 69.96. It's at 69.12. There's still room. Target at the top of the correction zone is 64.25. So it's not a catastrophic thing. I'm not saying Citigroup's going out of business. I'm saying technical pattern, normal, you know, cyclical price movement is they had a big run up, you know, up to $80, and it's clear, crystal clear that it's correcting from that move, and there's a high probability that it corrects into this Fibonacci retracement zone. We see it over and over again in orderly markets. And so I got my target set at the top of this. It could go lower, but you know, we catch a $5 down move, about a 10% move on Citigroup, and we're doing that. We're long the puts, make some good money on that. And it's a very high probability trade.
Yeah, I would actually disagree with you on Citibank. I would say that when interest rates are breaking out to a new 4-year high, you don't want to be short financials. And Citigroup actually is our only long position in the entire market. We put it on about $5 lower, and we're in the call spread. We're not in the stock outright. So if the market just kind of grinds sideways for 3 more weeks, we make the whole profit in there anyway. But the only way you would want to be short Citigroup is if you suddenly got a major move down in interest rates. that would really kill it. That would knock Citigroup down 10 or 20%. But right now, interest rates are definitely going the other way.
Yeah, and depending on, I don't know what your time horizon on your trade is, but I'm looking at about 4 weeks being in this trade. And so if your horizon is longer, we could end up both being right, because I still think there's some more pullback coming here. And
we have the 60-65 call spread, so we actually have to lose another $4 before we start feeling the heat on this, and we still have a profit in the position now.
Yeah.
But the entire financial sector universally sold off on their earnings, which were generally good, and that really set the pattern for the whole market, selling off on earnings. And once people figured that out, they just decided to sell. That's what today was about. Don't wait for the earnings, get out now. And that's worked pretty well.
I was tracking some of the big Dow components, big companies that released today: CAT, Lockheed, Verizon, 3M, Freeport, Coke, Harley, United. Man, they got CAT was up 5 or 6% pre-market, and after the open, and then things changed pretty dramatically.
So, well, CAT on their earnings call said that earnings were great in Q1, but that's it. That's the peak. They're going down from here. And when traders heard that, it basically set off a panic that not only Caterpillar was peaking in Q1, everything was peaking in Q1. So, the Trump economic miracle created by the tax cuts, which was supposed to go on for years and years, looks like it only really lasted for 1 quarter or 1 month if you're in the stock market. All the good news is in the price. Where's the next upside surprise coming from? Another tax package? I don't think so.
Right. And a company like CAT is pretty vulnerable to any trade tension that would continue to arise. Right?
Yeah, Caterpillar is a major trade war victim because they have a big factory in China.
Yeah. So I agree with you.
The largest customer, larger than the U.S.
I think your comment about what potentially is the good amazing news that could come versus what's the bad news that could come is really where the S&P 500 is sitting right now.
Yeah,
as well.
Looking forward, the possible causes of bad news greatly outweigh the possible sources of good surprises. I mean, you got trade wars, shooting wars, elections, and the Mueller investigation. None of those see stock prices going higher anytime soon. And that's what's really been capping the market for the entire year, is essentially the chaos in Washington.
Of course, we could have Iran say, yeah, you're right, we're going to drop the whole nuke thing. Sorry, bad move. That could be good news, but it's probably not going to happen.
Yeah, but the markets don't trade on what happens. They trade off of what people think is going to happen. And given the benefit of the doubt, they always think the worst.
It's an interesting comment. I love a quote from Benjamin Graham, who was the father of value investing. He really was his material was what Warren Buffett based his method on. And I love his quote. He said, in the long term, the market is a weighing machine. It weighs earnings, period. But in the short term, it's a voting machine. It votes based on what people think, or based on what their emotions are, what they think information means, or what they think the information is going to be. And that's really, as a technical trader, what I'm trading off of is the price pattern based on people's current voting and momentum for optimism and pessimism.
Yeah, and Warren Buffett worked for Benjamin Graham in the 40s.
I knew he was influenced by him. I didn't know they worked.
It was his first job out of college in New York.
But people over the last year have voted Square up pretty dramatically.
Yeah. Well, we caught the whole 400% move. We actually used Square in our company to settle transactions, and we loved it. Much cheaper than traditional credit card processors. So we recommended it to our clients, got the whole 400% move, and we literally sold our position this morning at the opening. And what's amazing with all of these tech stocks, the second they lose momentum, they drop 10% in a heartbeat. And that is exactly what Square did today. We sold with the stock up $1, and it ends the day down $5. So we are out of this now, and we are going to stand on the sidelines until we get another good entry point, which let's see where our next entry point is going to be 36.40 to initiate a position. So we only need a $6 drop to get into a really sweet entry point on Square for a long play. So I would just sit back, keep your powder dry, and wait for the sweet entry point at $40.
I think they're an amazing company too, and their products are cool. And you can't go to a small business like a restaurant or something like that now, where they don't come out with an iPad with a Square widget attached to it. And they've got a software business as well. They are dominating that space. It's cool to see a successful company like that be innovative and be successful. I agree with your price level down. I'm looking at 40 to 36 would be the sweet spot for this current down move to end, and that might be tradable. There might be some profit to take that down, and then according to a simple version of Elliott wave, after this huge move up and a correction down into the Fibonacci zone, the next move would be up again. And the next move, if we went to the middle of the Fibonacci retracement zone, just speculating because we're not there yet, then the next price target on the continuation will be up over $64, up to 80. So not too bad. But you could get some profit on this current move down. Probably get support right at the 200, right around $37. All right. Intel. I think I've said it before. You guys probably heard it, but I worked at Intel for 14 years. It was a great experience, great company.
Is that why you have the Intel logo tattooed on your forearm?
I do not. I do not. But Intel is actually the reason I got into trading, because when I got hired in 1993, they gave me it seemed like they gave me a lot of stock to come join the company, and then they gave us yearly stock options and employee stock purchase. And from 93 until about 2000, pretty soon we did not care about our base pay anymore. Just give me more stock, man.
You're right. Yeah.
It doubled and split like clockwork every 2 years for nearly 10 years. And a lot of millionaires were minted at Intel along with Microsoft. Sure. And so it caught my attention that, hey, this stock thing might be cool. And I started, that was about the time I got interested in trading and in the market. And I decided I was really, really good at it because look how much money I made. Turns out there's more to it than just being hired by a great company. Current thoughts on their stock, John? What do you think?
Well, it's same story as the rest of the chip sector. I mean, if AMAT is the Chrysler of the chip sector, then Intel is the Cadillac of the chip sector. Top end of the market, premium products, getting premium prices, coming out of a long period of sleep. We got in this current run in the 20s and bailed last week when it hit 54. And we're just kind of holding our powder dry until we can get back in. If you can get back in, anywhere around 48, that would be a sweet spot. I noticed that this alone among technology stocks actually held up today. We call these laggard technology stocks, stocks making a late move in the sector. So that was one of our first choices to buy, and we had a nice run in there and took profit. So looking to get back in on a more substantial dip.
All right. For me, this run is pretty mature. It's a little too late to get in. I don't see a good short setup for me yet. So for me, standing aside on trading Intel at this time. No trade there for me. WYNN. Yeah, in the news for sure. Less about their business, more about their namesake. Any trade there? Any interest for you in WYNN, John?
You know, we really don't follow the hotel sector. It's too low of a margin business for us. You know, when you're looking at the technology world, so we, you know, confined ourselves to reading about all the scandals in the newspapers, and that's it. You know, no real view on the sector, no real view on the stock, although it does have risks. They may be forced to sell their Boston property, which would be a big hit. And I stay at the Bellagio when I go to Vegas, not the Wynn.
Yeah, I have no, you know, I don't really know the company other than, of course, the recent headlines. It's been in a very long, methodical, you know, it's a plotter in terms of a stock, right? Did go from $60 to $180, nothing to sneeze at, you know, 300% gain. That's a very mature trend, and it looks like it's starting to lose momentum. And I don't think the correction is big enough. So I have no interest, and it's not proven yet. So there's no trade there for me on WYNN.
Yeah, and if we're approaching the end of the business cycle, these kind of Vegas hotel stocks are the last place in the world you want to be, because when the recession hits or the economy slows down, these guys just get absolutely slaughtered. And I'm talking about down 90%. And if you don't believe me, go back to the charts for 08, 09, when several of these companies went bankrupt and the rest had 90% stock drop. So, you know, it's a high risk sector with very limited gains from here. That would be my guess.
You talk about getting hammered in the recession. I was just reading articles last week about the city in Indiana, which is like RV headquarters for the United States. It's where most of them get manufactured. There's a huge concentration, and they can't hire enough people, and you know, the new car lots can't stock nice cars because it's such a boom in the RV business. But you get a whisper of a recession, and guess what? That's going to be a ghost town again.
Like so many other industries.
Yeah. Next up on our list here is Verizon. Verizon announced earnings today, and they were one of the few companies that actually went up today rather than bleeding off a little bit. So they went up 2.2%. You couldn't find an uglier chart if you looked. This is terrible, but I can't trade something like this. It is just all over the place. It breaks through support and resistance like it's not even there on a regular basis. Very hard to predict what it's going to do next. You know, you can be right about the trend here and still lose money, which is a lousy proposition. But I went first out of order. You got Verizon on your horizon?
You know, only as a short play. We've been shorting all these telecom companies for the dividend, play for the last couple of years. You know, they kind of go nowhere. And this is the problem. Regulation prevents them from going into the profitable parts of the economy. You know, these are very highly regulated companies. That's why AT&T is trying to merge. So they can get into more online businesses. So, I would stay away. Also, they're getting hit because these are traditional yield plays, and when interest rates are rising, you don't want to be anywhere near a yield play. So, I'm a pass on not only Verizon but the entire telephone sector.
All right, pass on telecom and Verizon. Next up, Raytheon. Big defense.
By the way, I looked up the low for WYNN in the 08 crash. It was $10.
Well, it made a nice comeback from $10.
Yeah, I would say it did. Well, it had Chapter 11 in the price at $10, as they all did at the time.
And those are not, I think I've read or heard you talk about how tech companies, have a tremendous advantage because they You know,
They're unregulated.
well, they fund their growth with cash. They don't have to borrow money.
Right.
And,
Yeah, they got money pouring in so fast they don't know what to do with it. So they have no need for banks or borrowing. And in fact, when interest rates go up, they benefit because they have anywhere from 50 to $270 billion worth of cash. So that cash hoard pays off a higher return in rising interest rates. And they are almost unique among companies in not having to borrow from outside sources.
and very few hotel companies are sitting on 100 billion in cash.
Yeah, I would say none.
All right, Raytheon, big defense contractor or producer.
Yeah, we're not a big defense player. They were dead for a very long time. Obviously, they've had this big move under the Trump administration, expecting more wars, and they're getting them. The last missile attack against Syria shot off $110 million worth of Raytheon missiles, which now have to be replaced. These things cost $1 million each. So, it'll probably keep going up. Obviously, had a bad day today, but as long as we keep blowing up foreigners, the fundamentals on this company look good.
It's nowhere, even though it dropped today 3.76%, nowhere near its support levels. So I agree. It's a long mature trend. It's in a growth industry.
Yeah, to say war is a growth industry right now for sure. This is probably one of the healthiest charts that you have put up so far.
Yeah.
No dips in this thing at all. So we have a bull market in war, and these guys sell missiles that cost $1 million each. That has to be a winning situation to be in.
I was actually in the Navy in the mid to late 80s, and I was a weapons technician. I worked on the missile systems on the ships, and I actually got to ripple off a couple missiles. That's a pretty cool feeling to pull the trigger and feel the whole ship shake, and a big old cruise missile takes off. Those are good toys.
Well, I was in the Marine Corps, and we used their missiles on our planes. They weren't the $1 million ones; these were the $10,000 ones. But still, is a buzz to see these things take off. Have a kill range of 75 miles. So, yeah, I see where you're coming from on that.
No, it was it's a unique experience to launch a missile. That's for sure. Not everybody gets to do that.
Yeah.
Ford. There's a whole different sector. I hope we're going to make it through the list today.
For the first time in history. I mean, often with 4 guests, we only get up to the 5th stock.
Yeah.
Yeah. I don't like the whole car industry. Again, another highly cyclical industry. You don't buy in the 9th year of an economic recovery, the 9th year of a bull market. They have been lagging in the electric area, lagging in self-driving, and lagging in hybrid. So that's why the stock has been awful all year. And I wouldn't touch this thing in a 10-foot pole. Longer term, a major part of their market share is probably going to get taken over by Tesla. Tesla's about to eat the lunch of all these guys. And at least General Motors has an effort out there in the form of the Volt and the Bolt. Ford really has nothing on the electric front that's mass market competitive.
No, and Nissan and Volvo and Jaguar, for crying out loud, all have, compelling entries. But yeah, you're right.
Yeah,
Ford.
right. Yeah, the management is just too conservative.
It's a terrible chart. It's in a sloppy, ragged downtrend. It's probably going to find support down here at about $10. That's probably the floor for a while, unless something really bad happens. So it's way too late to try and short that thing, and I don't see any upside, you know, from a technical standpoint, or just John's point about the cyclical nature of the business. And yeah, I'm not feeling it on Ford.
Yeah, this is not a stock you buy after the auto sales cycle has peaked. And, you know, General Motors, their stock doesn't look much better. So I would avoid the whole sector.
All right, last one here is our TLT iShares 20-year bond ETF. We shorted this earlier this year and caught a nice move on it.
Well, we've been shorting this every 2 weeks like clockwork, made money on every trade. The inverse of this is the TBT, which is the 2X short Treasury bond fund, and we've been long that. So this has been our rich uncle trade since July, when interest rates bottomed out on the 10-year at 2.03%. We've been, you know, on the TLT, we've been selling every single rally, covering on the dip. This thing has just been making money for us like clockwork. And, you know, we're probably coming to the end of this cycle. You know, my guess is that 10-year yields go to 3.25, maybe 3.5 tops this year. And we have no position. We just took profits on our last TLT short last week. So we're looking for, you know, a backup in yields to maybe 280. Then we'll go back on the short side again. Until then, we'll just, you know, pat ourselves on the back and say, job well done.
I would not try to short it at this level either. It would have to pull back up to about the 2072 level for me to look for another short. And it may be finding some support down here at the 118 level. So
yeah, Treasury short has far and away been the easiest trade of 2018. Hasn't given you the heart attacks and the nightmares that the stock trades have. But right here, there's nothing.
I agree. Well, hey, we made it through the whole list of 15 symbols, and we threw in a couple of our own. I'm going to show a quick chart of the S&P 500, if I may indulge myself. Pretty interesting, just from a technical standpoint. S&P 500, you know, the big move in January came right down to the 200, didn't pierce it, moved back up. This is now a lower high, and then in the early March move down, late March move down, it did pierce the 200, went right up to the cloud, reflected off of it. And if we see a break, a definitive close below the 200-day moving average here at about 25.95, oh, it's on, man. It is on. And if we bump this to a weekly view, you know, here we got this amazing 9-year bull market. The correction zone on this on the S&P is 2114 to 1657, call it. That's real. That could really happen. And that's not a catastrophe. That's not the apocalypse. That's just normal market cyclical behavior. I think if we pierce this 200 in a definitive way on the daily chart, we're switching over to the weekly, and we got that bigger correction happening. I'm on record, man. That's
okay, well, the world is not going to end. I think you're being a little extremist and sensational in your viewpoints here, but I guess that's common these days. You know, I think, you know, after last week's fail, break of the 200-day is in the cards, but we don't go that low. My bottom in this move is 2,400, and that we'll probably stay in like a 2,400, 27 range for the rest of the year, or at least until the November elections. I think we're stuck in a wide trading range until the November elections. They're a big overhang on the market. And you can trade around that. I mean, it's a very wide range, so it's trading wide enough so even beginners can make money, you know, buying these big capitulation days and then selling the euphoric tops, which we still keep getting. So, that is the play for the rest of the year. And I think after the elections, we'll take another run at the highs. But that's assuming 17 different things don't happen before then. So, that's a long time away from now. Just looking at this chart, I wouldn't buy this with Dean's money. I wouldn't buy this with Donald Trump's money. And I'd be shorting every rally, and we have done, and it's been one of our most profitable trades this year.
Well, I'm in agreement with you about not buying it.
Yeah.
So I do think, again, we look at that weekly chart. I do think we have a bigger correction coming, but we can disagree agreeably, and time will tell.
We have been shorting these rallies, and those have been big money makers.
Yeah, I don't think I'm being.
We've only had to wait 2, 3, 4 days for them to turn good, and we make just almost instant profits on every one of these now.
Yeah, I gave up day trading a number of years ago, but this is actually a good time to be day trading.
It is. It's probably the golden age of day trading. 700-point range. I mean, how could you miss on that? Last year was the worst time ever to be a day trader when you had an average 50-point range during the day. You barely covered your commissions.
Yes. I'm in agreement with that. So we agree on lots of things. All right. Well, hey, we're right at the end. Do you have any closing thoughts, a link you want to share, something like that, John, before we wrap it up?
Just go to www.madhedgefundtrader.com. There you can sign up for our free research product, get some freebie trade alerts. No, that's not me. That's you.
Yeah.
We have the top performing trade mentoring service in the industry, trailing 1-year return of 50%. And you will learn a ton of information on this site. There we go. I can see my my performance chart lurking down there, and it's actually much higher than that now. We have to update that chart. So again, madhedgefundtrader.com. I'm John Thomas, and I look forward to working with you sometime in the future.
All right, and it's good to be on with you again, John. And I am Dean Jenkins of followmetrades.com. This is my website, followmetrades.com. And a great way you can come here and read about me, how I pick winning trades, how I manage risk, all that stuff. And a great way to get acquainted is to sign up for my free newsletter, Beyond the Noise, weekly market analysis, and start from there. Again, I have a stock picking service. The exact same trades I'm taking in my own account with my own money, I share with my followers, and I also have a live trading room in the mornings and some training and mentoring programs. So that is it. And go ahead and turn it back over to David. Thanks again for putting it all together, David.
All right, thanks, guys. Yeah, that's cool that we got through the whole list. That might be the first time. So for everyone watching, if you saw last week's show, we had 5 guests on, or moderator, and 5 or 4 guests on that one. And then so just 2 guys on this show. So if anyone has any feedback on whether you like more people or fewer people on the show to discuss the stocks, be sure to let me know about that. And be sure to hit the YouTube subscribe button so you can get updates on future shows. And be sure to join us next week, Crowd Forecast News, April 30th, Monday, 1 p.m. Eastern Time, the normal time. Analyze Your Trade. This show will be off next week, but then back in 2 weeks. So May 8th at 4:30 Eastern Time. So just want to thank my guests again for this week. John Thomas of madhedgefundtrader.com and Dean Jenkins of followmetrades.com. Thanks, guys.
Thank you.